Hey guys, today we're going to talk about Chapter 8, the stock market, and especially the first two sections of Chapter 8. 8A, which is talking about stocks themselves, what they are, the different types, and also we're going to talk about 8B, which are the stock markets. Okay, so let's get started. I'm going to start with the scripture. He will be the sure foundation for your times, a rich store of salvation and knowledge. The fear of the Lord is the key to this treasure. Isaiah 33:6. So as we talk about financial things and businesses, I want you to always remember that the Lord is your foundation. He is your store of salvation and of knowledge. And so when you fear the Lord, you will have these treasures, which are worth way more than earthly treasures. Okay, let's keep moving. Last chapter, we talked about corporations and corporation as a business type. And we talked about corporations may decide that they want to open their corporation and offer stock. Stock is a share or a portion of ownership in a corporation. So people can buy stock in certain corporations and they own a portion of that business or that corporation. So there are different types of stock that you could own. You could own something called the common stock. A common stock is the most prevalent type, meaning there are more of these types of stocks that are sold. And you may receive dividends if a company has a profit. A dividend is money that you receive as profit on top of your stock. You buy your stock, you own the company, and if the company has profit and doesn't use that profit in another way, for instance, to develop a new product or advertising or something like that, and they have extra money or profit left over, then they pay back their stockholders a share of that profit. And the share that you would receive back is called a dividend. When you own common stock, you also have voting privileges. Now, if you only own one share of stock in a large company, then your voting privileges are pretty small. If you own a lot of stock in a company, then you may be able to vote, and your vote would count more in a larger company. But you have voting privileges about the company. But in a common stock, if the company fails and goes under, so to say, the business goes under, the stockholders, depends on the type of stock you're holding, will get paid last. So they have to pay off their debts, any other creditors, and if there's anything left over, then you will be paid if you own a common stock. A lot of times there's nothing left over and you lose the money that you put in for the stock. The other type of stock is called preferred stock. Preferred stock are the first to receive dividends if something were to happen, if the business went under or whatever. They receive revenue before the common stockholders if the company fails. But in a preferred stock, you have no voting privileges. So preferred stock, you're not really owning the business as you would in common stock. Preferred stock is kind of like you are buying stock to loan money to a business. So you're not really becoming an owner in the business. You're buying stock for the business. You're hoping that that business, they will return your money with interest, kind of. So your dividends would be like the interest payments on a loan. So in preferred stock, you really don't own part of the company as you do with common stock. But with preferred stock, you get paid first because you're kind of like a creditor for the company. Okay, so selling stock. The reason that corporations sell stock to begin with is to raise money for their business, to raise money for the corporation. When a corporation decides to sell stock, they can go onto what they call the market, and they can open up an initial public offering, which is an IPO, and it's the initial sale of a company's stock, and this happens through some sort of an investment bank. There's a specialized place that they do this, through an investment bank. Now, how much of the stock that they open up depends on the corporation. So they may not open up very many shares of stock, but it allows them to raise the necessary money or capital that they need to keep their business going. A lot of times they don't open up enough stock to lose the majority of their ownership. Whoever owns the company, or the major stockholders is what they're called in a company, they want to open up enough stock to where they lose the majority, because they are the ones that want to be the voting partners that make the decisions. Okay, so if a company decides to sell stock, you can buy stock. When you buy stock, it's done through a stock broker. A stock broker is a stock salesman, basically. So you buy stock, hopefully to make a profit on your stock and to receive dividends. Dividends are those profits from the business that you own stock in. Okay, so when you buy a stock, the stock has to be offered, of course, through the corporation, and you want to choose some sort of a business or a stock that you want to make money from. So you're going to try to seek to make a profit, and then hopefully, if the business does well, you will receive dividends, which are shares of the profit. So one of the things in stock buying that you may hear is buy low and sell high. So when you buy a stock, you probably want to, well, a lot of times people buy stock at a lower price. And then when the price of that stock goes up, they'll sell their stock. And so if they buy their stock at $30 a share, they notice in the market, because of trends in the market, which we will talk about soon, then the stock price is increasing. Let's say you bought it for $30 a share. Now the stock price is $70 a share. You may decide to sell your stock to someone else in that company. At that point, you make a profit on your stock. Then you can take that money and buy a different stock if you want, or you can take that money and invest it somewhere else, or save it, or whatever. But when you buy a stock, usually they say to buy low. So when the price is low, let it mature, and then when you see that the price is going higher, then you may want to sell it. You may not want to sell it, but you may want to sell it. But that's the thought about buying stock. Buy it while it's at a low price, sell it when it's worth a high price. Okay, so let's talk about the stock market. The stock market is where stocks are sold. So it's like a supermarket, but for stocks. Early stock markets were called stock exchanges. So merchants, people that wanted, corporation owners would go there to try to sell their stock to other people. The first ones actually appeared prior to the 1700s, which was kind of interesting. And mainly those were in Europe, Great Britain, in the Netherlands did that. So they started these places, these stock exchanges, so that people could actually come in and own part of the business. Now, in the United States, the Philadelphia Stock Exchange was founded in 1790, and it was the first stock exchange in the United States. So the Philadelphia Stock Exchange was the first in America, and it came in 1790. Then you've probably heard of the New York Stock Exchange. The New York Stock Exchange was organized in 1792, so just a couple of years after the Philadelphia one. But the New York Stock Exchange is the most well-known in the world right now. It outgrew the Philadelphia Stock Exchange, and it's still one of America's financial centers today. There are several other stock exchanges in the United States, including cities like Los Angeles, Boston, Cincinnati, Chicago. And there are other markets, which are kind of interesting, that do not have an actual building, and we're going to talk about those in a little bit, but they are virtual stock exchanges. Okay, so the early stock market, the first one in America was in Philadelphia in 1790, and then the New York Stock Exchange in 1792. Here's a picture of the building of the Philadelphia Stock Exchange, or they were called the Bourse House. Borge House or whatever. I can't say very well, but this is a picture of the building in Philadelphia where this occurred at the beginning, and I don't know if how much business is still handled there with the Philadelphia Stock Exchange. These are two different pictures of the New York Stock Exchange. The one on the left is a familiar picture of the New York Stock Exchange. It's on Wall Street. You've heard of Wall Street, I'm sure, in New York City and Manhattan. And now, after the 9/11 incident, the New York Stock Exchange has a very large flag across the front of it, and it stays there permanently. Inside the New York Stock Exchange is the picture on the right. And inside the New York Stock Exchange, every time you see a picture of it, there's a lot going on. There are people inside, stock brokers, what they're called, and they're buying and selling stocks for other people. So they are agents buying and selling stocks for other people. And it seems kind of frantic in there because all of these different companies and all these different buyers are trying to sell and trade stock at the same time. So it's kind of crazy. Okay, but that's a picture of the New York Stock Exchange. Okay, so the reason stock exchanges exist are to facilitate buying and selling stock. So actually it makes it easier for the common person, you and I, to buy stock into a business, or for them to sell stock to us for a business. Sometimes it's a literal physical location. Actually, like the New York Stock Exchange is a literal place. People go there, they buy, they sell, they trade there. Some organizations, like I'm sure you've heard of the NASDAQ, which is the National Association of Securities Dealers Automated Quotations, which they're a market, but they are actually a virtual market. Theirs is an electronic virtual market. So you don't actually physically go to a place for that. The New York Stock Exchange we talked about, and New York Stock Exchange is a prestigious place. So when you think about this, you're like, why is it prestigious? Who cares? Why does it matter if I buy my stock at the New York Stock Exchange or the NASDAQ? Well, the New York Stock Exchange and the NASDAQ and the Philadelphia Stock Exchange, they have different companies that they trade in. So, for instance, the New York Stock Exchange holds a lot of companies that are very prestigious. So, they're prestigious companies that people want to buy stock from. The same with the NASDAQ. They have companies that other places you can't buy stock in their companies unless you come to them. So those companies let the New York Stock Exchange handle their stock sales. And some companies let the NASDAQ handle their stock sales. So if you want to buy stock in a specific company, you have to see what exchange are they trading on. So you can't just go and say, oh, I want to buy stock from this place, because that market may not handle the stock from the company you want. Okay, so NASDAQ is called the over-the-counter trading. In the over-the-counter trading, there's not a physical location where traders meet like the New York Stock Exchange, but the NASDAQ is the largest exchange that does not have a trading floor. Instead, the market will post stock prices to an electronic network, and the dealers who are registered with the market will perform the trades. So they don't have a physical location. So they have market traders, stock traders that go into a virtual situation, a website database, and they go in and make trades that way. So there's not like a physical location for the NASDAQ. Okay, so there's another American market called the American Stock Exchange, or the Amex. And a lot of these operate exclusively in certain regions of the country. Of course, other countries have stock exchanges. Japan, Tokyo Stock Exchange, Hong Kong, London. So there are a lot of different markets where you could buy stocks. Oh, whoops, there's Tokyo, London, Hong Kong. Sorry, forgot about that part of the slide. Okay, let's talk about what is a stock index. right now this is a big, you see this in the news a lot. The stock market, is the stock market closing at this rate? Or the stock index was this or that. So a stock index is just a group of companies or stocks for the companies, like stock prices for companies, that analysts use to compare the activity. So they look at these companies. For instance, there's an index that most people have heard of, and it's called the Dow Jones Industrial Average. Charles Dow was one of the founders of the Wall Street Journal, and he developed this index called the Dow Jones Industrial Average, and it's an example of how a stock index works. So the index consists of prices of 30 stocks, which are the most traded on the New York Stock Exchange. So some of these stocks include stocks like Visa, IBM, Apple Corporation, Verizon Wireless, Disney, Microsoft, Coca-Cola. Those types of stocks are the ones that are traded on the New York Stock Exchange. So the Dow Jones takes 30 different stocks and different, that's not all that the New York Stock Exchange handles, but they take 30 stocks in different areas, different types of businesses and industries, and they look at the stock prices and they see, are the prices high, are they low, and it's just kind of a measure or an index of what's happening, of economic growth and economic stability. Another stock index that we use, there's stock index, which is a group of stocks that analysts use for certain industrial categories to report the behavior of prices within the categories. So if they're looking at media, I don't know exactly what categories they have off the top of my head, but if you look at, certain categories of stocks, they're going to look at these specific stocks and see, are these stocks trading high? Are they trading low? And what from this information, what do we know about the stock market? Are we expecting it to be high? Are we expecting it to be low? Okay, so again, the Dow Jones Industrial Average is one of these stock indices. Another one is called the S&P, or Standard & Poor's 500. So whereas the Dow Jones only looks at 30 different companies, Standard & Poor looks at 500 different companies. So the S&P is a broader perspective, and the S&P not only tracks corporations engaged in industrial production, but they also look at other types of businesses, service industry, for instance, that kind of stuff. So the S&P is a broader indices on the market. And then some various stock exchanges publish their own indices that serve as economic indicators. So we call those composite indices. So for instance, the New York Stock Exchange gives a composite index, and it covers the over 2,000 stocks that it lists. So it looks at its stocks and it will say it closed at this today, and so it will give you an actual composite of what it did. Okay, and then there's industry-specific indices. So if there's a specific industry that you're looking at, like Microsoft, IBM, Apple, and you're looking at technology industries, you might look at all the different industries and look at their indices, see what are their stocks trading high, are their stocks trading low today, what's happening in these trends for these stocks. Okay, so stock market, in recap, a stock is owning a part of a business. A stock market is where you would buy or sell stocks. The importance of a stock market is to provide a place, a venue for the sale of stock. It also enables corporations to raise money or revenue for their corporation. So that's important for them. And it gives investors opportunities to invest. So if you want to invest some money in a corporation, then you're able to do that through a stock market. And you're also able to, a lot of times, able to make money on your investment. and it provides information to the market, to market people. So like we talked about how markets are driven by supply and demand. So this is the same kind of thing. If stock prices are trading and a lot of people are buying it, the demand is up, so the price will go up. So it's the same kind of concept that we talked about before. And I'm going to leave you with the scripture. Dishonest money dwindles away, but whoever gathers money little by little makes it grow. So Proverbs 13:11. Okay, in our next PowerPoint later this week, I'm going to talk to you about the market economy and how the market helps drive our economy. All right, hope you enjoyed this one.